Hello, everyone, and welcome to another edition of our Visionvest Financial Digital Discovery webcast series. My name's Arnold Machel. I'm the founder of Visionvest Financial and a certified financial planner with IPC Investment Corporation. Today, we're talking about bear market perspectives and what you can expect next for your investments. I don't think it's any surprise to anybody. We're in a bear market right now. A bear market's defined as a drop of 20% from a stock market's previous high, which in this particular case was mid-February. We're going to talk about the 4 stages of a bear market. John Reckenthaler from Morningstar wrote this paper about the 4 stages of a bear market. We've added our own analysis to his framework to see where we're at in the cycle. We're going to talk about what's likely to happen next, and finally we'll conclude with some strategies that you can take away and talk to your advisor with about making sure are happening. If you're one of our clients, certainly that's something we're already doing on your behalf. You don't need to worry about that. Stage 1 of a bear market is the recognition stage, and quite frankly it is really difficult to do in the early stages. The thing is, markets tend to rise and fall frequently and often. They're volatile. Every year or two we see a drop of 10% before they go on to new highs. Drops of 5% are even more frequent. So if we treated every one of those drops as though it was the beginning of a bear market, it would be hard on the nerves for one, but also it would lead to a whole bunch of false positives. We'd end up jumping out of the markets and not participating or possibly not participating in the recovery. There's an old adage that the only way to experience every day of the ups is to experience every day of the downs. So this current bear market, well, it started off quite nice. If we look here at the beginning of the year or throughout the year, markets crept up. And then in mid-February, we saw this precipitous decline. It was about an 11% decline. And so at that stage, you're wondering, okay, is this going to be a bear market, or is this going to be one of the regular, happens every once in a while things, and is it going to bounce back? So it started to bounce back, but then it fell further, landed in bear market territory, and continued on with its descent down here, ending about 35% down at its bottom, or well, that still remains to be seen. I guess we don't know for sure that we hit bottom before, but at that stage, that's where it went. Now we're looking at the S&P 500 here. The TSX was very similar. It followed a very similar pattern. Stage 2 of the bear market is generally is the panic selling stage. We entered that right here or around here. So this here was that 11% decline, the little recovery, and then when the drop started to occur there, we saw the panic selling, which led to the further decline. Now, this was the fastest decline since the Great Depression, and as I said, led to that 35% decline. The third stage is the stabilization stage, and it's sort of a stabilization, and frankly, I think this is where we're at right now. Again, remains to be seen. We'll look at this in the future. We'll look back and we'll know then. But stage 3, the panic has subsided, but there's still a lot of bad news. The situation still seems pretty grim. This period tends to be marked by a lot of turbulence. And again, like I said, I think we're here right now. If you just look at, just this 1 week, we saw stocks rising up off the bottom, falling, rise, fall, rise, fall. Now, actually, at this stage, we already had a number of market pundits saying, oh, the bear is over. But clearly it wasn't, because it fell further. Now, since then, it's come back up. But again, we won't know until later on in the future. Stage 4 is what we're waiting for. It's the recovery stage. And we hope that happens sooner rather than later. Again, we don't know. But this is where stocks start to move, and they just keep moving, going up. But just like the beginning of the bear market, it's almost impossible to recognize until long after the fact. Just take a look at 2008, 2009 here. At this point in time, so the bottom was this March 9th, 2009 period. At that point in time, we still had a lot of terrible economic news. month after month it was bad. It was actually still 2 more quarters after this of negative economic or GDP growth. So there's probably not too many people, there's probably not anybody that on March 9th said this is the start of one of the best, most profitable bull markets in history, and yet that's really what was the case. When's it going to end? This is another thing we don't know, and neither does anybody else. We had the sudden drop in the markets, the fastest since the 20s. Does that mean we're going to have one of the fastest recoveries? Who knows? It might. But one thing we can look at for some perspective is how other bear markets have done in the past. So if history is any guide, and it's the only guide that we have, bear markets tend to last as little as 6 months for the short ones, and other than the 1920s, as long as a couple of years for the longer ones. Now, I happen to think this is going to be one of the shorter variations, but the real truth is we just don't know. What we do know is that historically, particularly the stabilization period that I think we're in, has a lot of these ups and downs. You just take a look here at this chart from 2008, 2009. Well, this one I guess is just 2008, but it shows as things were going down, all of the fits and the starts, the blip down and then the bounce up. And so you can see here the S&P 500 bounced by between 9 and 19% 6 times just during this 3 or 4 month period. So what can you do during this time period? So a few things you can act on. Start by reviewing your plan. Make sure it still makes sense for you. Again, if you're one of our clients, this is something we're doing on a regular basis for all of them. Stay diversified. Make sure there's some downside protection included in your portfolio. Strategic tax loss selling is something that many advisors miss out on. And it's something that you want to be proactive. Talk to your advisor about. See if it makes sense for you. It's only applicable to non-registered accounts. And it's something that allows you to carry losses back a couple of years and claim back tax that you've paid in the past, and you can carry those losses forward indefinitely until you use them up against other gains. Now, certainly continue on with your regular deposits, increase them if you can actually. That way you can lower the cost of your investments. If you don't need the money that you're taking, minimize any withdrawals that you're taking. CRA has allowed us, or the government has allowed us to reduce RIF payments by the minimum RIF payments by as much as 25%. In many cases, that actually would allow you to reduce them even further at this point. So if you need the money and you're one of our clients, we've built your portfolio to withstand these things. We know that they happen on a regular basis. You don't need to take it. If you need that money, take it. But if you don't need it, don't take it. Now is a great time to minimize those withdrawals. And finally, kick around the idea of increasing your equity exposure. If you're a very conservative investor and you've got a conservative portfolio, consider bumping that up to balanced. If you're balanced, consider bumping it up to growth. You can do that all at once or bit by bit over the next 6 months. Either way, long term, that's likely to be of significant benefit to you. Just recognize it is increasing the risk of the portfolio. So you do want to make sure you're talking to your advisor about that, seeing if it makes sense for you. If you're one of our clients, you know how to reach us. If not, you can find us easily on the web or just pick up the phone. Our contact information is right here. This has been a Visionvest Digital Discovery webcast brought to you by Arnold Machel, Visionvest Financial Planning and Investment Planning Corporation. Thanks for tuning in.
Would eat Kraft in it. Of course we would. We just eat more. And buy really expensive ketchups with it. That's right, all the fanciest Dijon ketchup.